One of the most common questions I get from small business owners is, how do I actually pay myself? If you're a sole trader or run a company, the answer looks completely different, and getting it wrong can cause headaches at tax time. In this video, I'll break down how paying yourself works in each structure, what the ATO expects, and how to do it in a smart way. Let's start with sole traders. When you're a sole trader, you and your business are legally the same person or the same entity. That means there's no separate entity, no wages, and no formal payroll. You're simply drawing money from your business profits. So here's how it works. All the money your business earns goes into your business account. You can then transfer that money to your personal account whenever you like. That is called a drawing, not a salary. The amount you take doesn't affect your taxable income. You're taxed on your total business profit, not on how much you pay yourself. So if your business makes $80,000 worth of profit, you'll pay tax on $80,000, even if you transferred $50,000 to yourself. So pro tip, keep your transfers consistent, like a weekly, fortnightly pay, so that you can budget and manage your cash flow better. So how does it work as a company owner? Now, if you have set up a company, things change as a company is its own legal entity. That means your company earns the income, pays the tax, and you, as the owner or director, get paid separately. You've got two main ways to pay yourself from a company. The first is salary, wages, or director's fees. It's all treated the same. You become an employee of your company, get paid through payroll, and the company withholds tax, PAYG, and pays superannuation for you. This is the most common option for directors working full-time in their own business. The second way is dividends. Once the company earns a profit and pays company tax, it can distribute those profits to shareholders. That's you as the owner, as a fully franked dividend. Dividends are taxed at your individual tax rate, but they may include imputation credits or franking credits to offset tax already paid by the company. A lot of small business owners use a mix of both, a modest salary during the year and dividends at tax time once profits are finalized. So what's the key differences between sole traders and companies? Let's recap. As a sole trader, you and the business are the same entity. You take drawings, not wages. You pay tax on business profits, and no super guarantee is required. As a company owner, the company is a separate legal entity. You can pay yourself a salary or dividends. The company pays tax, then you pay personal tax on your income you receive. Super must be paid on wages. And if you're growing, hiring, or moving from a sole trader to a company, you can make paying yourself and managing tax a lot smoother. Tips to pay yourself properly. Here's a few simple tips to make sure you're paying yourself the right way. Always use a separate business bank account. Keep your personal spending separate. Set money aside for tax. Whether you're a sole trader or a company owner, don't spend everything that hits your account. The ATO will want their share. Pay yourself consistently. Even as a sole trader, regular drawings help with budgeting and cash flow. And get advice early. If your business is growing, talk to an accountant about whether your current structure still makes sense. So whether you're a sole trader or a company owner, the key is understanding how your structure affects how you can get paid and setting things up properly from the start. At Lawpath, we help small business owners get their structure, tax, and compliance sorted so they can focus on running their business, not stressing about the ATO. Visit lawpath.com.au to get started, and don't forget to like and subscribe for more quick and practical business tips.